Okay, greeting guys. Don't forget to subscribe my YouTube channel at Wavetracer Community, and you can also subscribe to my Telegram channel, Wavetracer Community. Okay, so today I'm going to talk about the Elliot wave for beginners. I'm going to talk about the principle behind Elliot wave, and also I'm going to talk about the types of entries and possible stop loss and take profits. Okay, so I think this video might have a part 1 and a part 2. I shared this trade earlier and it is almost about to happen. Okay, so I'm just going to take a random pair. I'm going to take a random pair and hide it. I want to hide. Okay, so basically Elliot wave is a theory which um, anticipates market movements in 5 impulsive waves and 3 corrective waves. So we expect market to have the first wave, to have the second wave, which might be long or short. We also have a third wave, we also have a fourth wave and a fifth wave. All of this is this is this is a full cycle, a full Elliott cycle. In the full Elliott cycle, in this time frame, when we go to the next higher time frame, we might only have a few candles, maybe 3 candles, or we might even have a 1 candle in the next higher time frame. So we expect after these 5 moves, we then uh, we are going to have corrective move, which manifests as ABC, which is what we call the consolidation. And then we are going to have another 1, 2, 3, 4, and 5. Now I'm going to get specific on the wave characteristics because that's what matters. More than anything. Okay, so there are variations to this theory. First of all, before progressing, maybe if I will show you a chart, it will be much more convenient. So we have a first wave, second wave, third wave, fourth wave, fifth wave, corrective wave ABC. We have our first wave, second wave, third wave, fourth wave, and the fifth wave. But there are variations in these consolidations. We only have, in a full wave cycle, we only have 2 consolidations, wave 2 and wave 4. So sometimes wave 4 might be the elongated consolidation, something like that, or sometimes it might be the short consolidation and the wave 2 might be the long consolidations. These variations are what makes the market harder, and they determine the take profit, the entry, and everything in this theory. Also, that might happen here. I'll talk about the variations later. Let me go to the real chart. It is easier to appreciate these structures in the high time frame. For example, I'm going to look for the structures. Okay, I'm going to look for the structures. For example, here I'm looking for very clear structures so that we cannot mix the structures. Okay, so I might just take somewhere around here. The toughest part in Elliott wave theory is determination of the first wave, but I'm going to explain how we determine our first wave and how we progress with our Elliott wave structures. So here it's still very cloudy. You want a structure that is typical, as what I presented earlier. Okay, so I think here we might have something that's closer to what was anticipated. Okay, so from this presentation here, I think that we had this as our lower high, lower low, lower high, lower low, and somewhere around here price made another lower high but failed to create another lower low. So this is where we are interested. This is where we are interested, and it is where we are going to find our first wave. If we could have had a higher time frame to monthly, we could have then gone to that time frame to wait for a full candle breakout in this structure. But from experience, I can just see that I have all of this as my first wave, because in the higher time frame this might be just a single candle, and first wave, second wave, third wave. In this case, the fourth wave is the elongated wave. But we expect, if the first wave and the second wave are of approximately the same length, as you can see here, we expect the fifth wave to be the elongated wave. We must always have an elongated impulsive wave and an elongated corrective wave. So in this case, our elongated corrective wave was the wave 4, and our elongated impulsive wave was our wave 5, as you can see here. So we could have traded something which we call the wave 5 continuation trade, which I will talk later. And in this case, it could have been better because we expect elongated wave 5. As you can see, this was what we expected as the normal length, but the price have elongated. So in a pictorial presentation or a graphical, we could just say that we had our first wave here, then we had our second wave, then we have our third wave, then we had our fourth wave, and then we had that as our fifth wave. After the fifth wave, we expect to have ABC reversals before trend continuation or reversal. I was looking for a typical setup, but I failed. So ABC, so we could have had another entry here, but I usually don't recommend trading after the consolidation. So we could have had another entry here, and we could have expected maybe the price to break somewhere above there. Okay. I'm going to use gold. Maybe gold will give us a nice setups. Okay, this from Rwanda. Okay. Okay, so maybe we could have just used the current market price won't give us a best setup. Okay, so this we can see that we can start from somewhere around here, because when you see a structure like this is like a bullish flag. When you see a bullish flag, it means that the price recently had a bullish run, then a flag, and another bullish run. So we can just start from the flag. From the flag, price made a higher high, then a higher low, a lower high, then a lower low, then a lower high, then a lower low. So around here, we expected the price to break and form another lower low, but the price failed, so we are interested in this area here. We are interested in somewhere around there. So from this place, what we're interested in is that we have to find our first wave. Usually, our first wave begins from the week of the breaker to the top. But we can see here that when we go to the higher time frame, this structure would have not broken this previous structure. So all of this is inclusive because all of it was involved in a break of previous structure. Okay, so all of this will be our second wave. So we had our first wave, we now have our second wave around here, and all of this is our third wave to somewhere around here. Don't mind about the structures because sometimes what matters is the mathematics. So here we have our third wave somewhere around here. But if you can see clearly, we had our first and our second wave was a short consolidation. So we must find a long consolidation before we say that this is our fourth wave. So which means if this was our first wave, all of this was our first wave, and our second wave is somewhere around here, all of this is our third wave. So it means this is not our third wave. All of this until here is our third wave, which is the elongated wave. And all of this is our fourth wave. And so we expect the fifth wave to be short, not long as we expected. So when we place this box here to reflect the length of the fifth wave, we can see that it was approximately around this area here. So we could have just taken our short position here and then had all of that. So in terms of our linear presentation, this could be our first wave. Our second wave is somewhere around there, second wave which is short, so we expect all of this to be our third wave because here is where we had our long consolidation of the fourth wave, and we also had our fifth wave. So whatever that came there as a consolidation, that is the ABC. So we had our ABC before reversal. This kind of trend is called the wave 5 reversal trend. And it is my favorite trend, wave 5 reversal. So we could have taken